This episode is brought to you by Fiscal.AI, the fastest growing stock research terminal on the internet. You'll hear more about Fiscal later in the show. Let's get into it. We are thick into earnings season. The big banks have just reported. I'm joined by my friend and business partner, Max Wheathy of Other People's Money. Max, good to see you.
Good to see you too, Jack. What did we get out of those bank earnings this week?
Well, from the big banks, Max, there's a lot of good news that I'll get onto later on in the show. But as credit people are always focusing on the bad news. So let's get into the bad news. Zion Bank and Western Alliance Bank, two banks focused on the West Coast of the United States, put out some reports on Wednesday and Thursday in middle October that really did shake markets. So on Thursday, October 16th, the XLF financials ETF was down about 2.5%. And then the bank index, the KBWB, was down even more. So it's weird. The credit market and just bank shares in general are not really going up a ton on good news, and then on bad news, they seem very anxious, very jittery. The news, Max, it's very niche, so you'd be surprised on like a macro show that we're talking about this. But basically, so the allegations go: three individuals, Gerald Marcil, Andrew Stupin, and now Deba Shyam, had an investment fund that Zion made loans to that went bad, and basically Zion alleges fraud. This is the evening of Wednesday, October 15th. Subsequently, Western Alliance Group says, in response to queries about our thing, yes, we also are realizing a loss. So Zion's loss was 50 million, so they took the hit up front. Western Alliance loss, they actually didn't say. So these seems like, even for these regional banks, kind of small losses that shouldn't matter to a market that measures in the tens of trillions of assets. But it just seems like the market is a little bit worried. First we get Tricolor, then we get First Brands, then we get this California real estate deal gone bad, even though the losses are kind of small. And it is quite strange, Max. And Jamie Dimon said a quote about cockroaches on the call. He said, I probably shouldn't say this, but usually there's not just one cockroach. So I think there have been three cockroaches so far. First Brands by far has been the biggest one. And Max, I wouldn't say that in a quarter you have three of these things, or it's not that big of a deal. It's about the direction of travel. We've been in an extremely benign credit environment where asset valuations are high, credit spreads are very low, and things are kind of just priced to perfection. So I think that the I don't want to say the good times could be coming to an end, but the environment we've had over the past 2 years is unusually good, and maybe things are coming to an end. That doesn't mean we're headed for a recession. It doesn't mean that there's every single thing is going to be a fraud, but people should be aware of this.
I think what you said about everything being priced to perfection has something to do with the market's reaction to it. When you think about, if you try and push over a person standing still, you got to push them pretty hard. But a sprinter who's running at full speed, sometimes it's just a little touch. It's a little touch and they go tumbling down. And the market has definitely been at full speed, especially the financial sector with the asset managers, like the private credit managers have been doing phenomenally well. Certainly banks have been doing well as people have been expecting rates to come down.
Yeah, and Max, I did do a little sleuthing, and I'm a little proud of this, to be honest. So one of the three individuals, Gerald Mansell, he goes by Jerry. So the fund, Max, that they all had, Mom California Investco, it filed for bankruptcy protection in the winter, so a while ago. But this guy, Gerald Stansel, went on multiple podcasts in the interim, or at least over the past few years. And 3 months ago, on July, early in the summer, on July 9th this year, he went on a podcast, and the YouTube title for the podcast was "This 72-year-old never sells real estate. Here's why," with Jerry Mansell. And he talked about how last year, so 2024, was his biggest year ever in terms of buying. And he talks about how the math of deals, how Jerry analyzes deals in 5 minutes. So making, sometimes he sees a deal, he buys deals in 5 minutes. And look, if you're a veteran of real estate, sometimes you see a deal that's so easy that you do know in 5 minutes it's going to be a deal. But the idea that this guy who has been accused of fraud. It was a few months ago, was going on a podcast talking about how he does deals in 5 minutes and how last year was his biggest year ever. It does raise some concern, at least about maybe the multifamily environment in multifamily, so apartment building market in California. Um, Not even that there's a real estate bubble in terms of prices, but that people are things are getting overheated. Maybe not that there's a bubble in prices, there's a bubble in activity, and there's a bubble in in borrowing. Maybe.
I think the housing market would say something otherwise. So perhaps in the commercial multifamily space, that might be the case. Certainly not in residential for anybody who's like, hey, real estate market is not hot. We're talking about this other corner of the market. But
Exactly.
I
Yeah,
think
I'm
just
talking about the apartment multifamily market, and I have had on and continue to interview people who are bearish on the single family house market, but the data there, single family houses have continued to appreciate, and actually, I'll go on this later, but like literally, Bank of America is their charge off rate on home equity lines of credit is negative, meaning that they're basically they're taking negative losses on credit. So it's quite good. So single family credit is quite strong. At least appears to be very, very strong.
I think it's worth juxtaposing what happened with this California real estate deal with the first brands, right? Like, to what degree is this people um, not being able to make good on their loans because the the music has stopped playing, or because they've gotten out over their skis? And I think in both of these cases, if you look at the behavior and the statements of Jerry, it seems like he might have gotten out over his skis, and obviously with what's coming out about first brands, certainly got out over their skis, got over levered, and really just took on too much. And not that, at a when it's that's systemic, like in 2008, we collectively as a society got out over our skis. And so maybe that's the question people have. But this does not seem like the music has stopped playing to me. You alluded to some of the positive earnings that came out of the big banks, and that would be indicative that no, things are just fine. Like, sometimes what happens is
Yeah,
people just take on too much leverage, and you have a bankruptcy, right? That doesn't
that's true. Yeah,
necessarily mean
bankruptcy is normal, and during an expansion, there are many, many, many bankruptcies, and there often is a chart showing like that bankruptcies are on the rise. But a lot of those charts start in 2021, which was among the lowest bankruptcy rate ever. So I don't believe that for 2025 bankruptcies right now are so much higher than they were in, say, from 2011 to 2019. I will say, Max, I did a little bit of sleuthing, and there's an LA Times article from 2017 talking about Jared Marcil. And he was quoted as saying that he makes $5.5 million a year running his company. Now, in this podcast released a few months ago in 2025, he said that the the annual run rate of the basically the rental income was $100 million a year, or 90 to 100 million. Let's say 100 million. So there's after debt costs. Let's say it's 20 million. Those are like very, very conservative estimates. That would mean that his business has gone up 4 times since 2017. So this is a guy who's been expanding, and maybe he's been expanding a little bit too much. Max, I want to go to Jefferies. So Jefferies released its earnings yesterday. It also released a letter on Sunday from the CEO, Rich Handler, who, by the way, I would love to interview. Maybe now is not the best time, but at a later date in 2025, 2026, I will definitely be fair. He talks about things that kind of everyone knows, that Jefferies has sound financial condition. He has $11.5 billion in cash, momentum in its business, strengthened partnership with a Japanese bank. But he says, did Jefferies earn undisclosed fees on financing it provided to First Brands Group through a side letter? He says no, they did not. Also, the exposure is 45 million, very similar to the 42 or 43 million number that I quoted last week. Regarding redemptions, Lucadia Asset Management, which is owned by Jefferies, communicated with Point Bonita Fund investors. So basically, they got ahead of this, and they said that Jefferies' investment banking relationship, they only served as a financial advisors to First Brands once in terms of an acquisition. And they say that nobody at Jefferies was aware of any fraudulent activities at First Brand. We learned of the fraud allegations when the rest of the public learned. So this is relevant, Max. And I think that even if Jefferies what was guilty, they probably would say something like this. But I think that it points to the fact that the real risk to Jeffries is not the loss of First Brands; it's the potential loss of reputation because there were concerns that Jeffries was aware that First Brands was doing these bad things. So I just want to give fairness to Jeffries, and sometimes famously with Enron, like when people CEOs make commentary. Sometimes they're fraudulent, not telling the truth, but vast majority of the time that they are. So I think that keep an open mind about the story.
Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best-in-class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy-to-use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview.
Now, that's the bad. You've alluded to the good. I alluded to the good. Let's get to the good. What about JPMorgan, Bank of America? They had fairly strong earnings.
Bank of America, JPMorgan, to a lesser degree, Wells, they have two sides of the bank. They have the investment banking, which is asset management and investment banking, sales and trading, and then the old school commercial banking side. I'm not going to go in deep on the investment banking side, but safe to say that it was extremely strong. Obviously, with the if the tightening in financial conditions continues, that will cease to be the case. But it was just strong. Let's just put it at that. People can look at the numbers themselves. On the credit side, on the commercial bank side, I do have some numbers. So Bank of America's credit provision was 1.3 billion versus 1.5 billion a year ago and the same quarter. So Bank of America took fewer credit losses in literally every single category, lower in commercial real estate, lower in consumer. Their total net charge-off rate was 47 basis points versus 58 basis points last year. Importantly, Max, I like to pay a lot of attention to credit card delinquencies. Bank of America's credit card delinquencies for 30 days was 2.41%, which was down from the previous quarter, and it was down from the year before as well, which was 2.54%. Now, I will note, Max, that purchase volumes were only up 2.7% year over year for credit card spending. So this does indicate a relative tightening of credit because inflation has basically been at literally 2.7%. So inflation adjusted credit growth of 0%. So this is not a boom time by any means. And I'll say, is it evident that the consumer credit card delinquencies have eased in Bank of America, JP Morgan, Wells Fargo, and others? Yes, that is pretty unambiguous to me. But does that indicate a relative easiness of credit or performance of credit across the entire economy? I would say not necessarily, Max, because with Bank of America, you see that banks are pulling back on the credit line. So delinquencies are going down, maybe because the consumer is doing better, but I think a big reason that delinquencies are going down is because consumers are pulling back on loans to their riskiest customers.
But wouldn't we have seen those delinquencies prior? Did we see a wave of delinquencies of those riskiest customers that justify this pullback in credit?
Yeah, delinquencies. So they spiked briefly in 2020. Then delinquencies utterly collapsed during the boom times of 2021, and they were ridiculously low, like lower than they've ever been. I'll close on record. I'm pretty sure. In some banks, definitely. And so delinquencies have risen. So the recession calls delinquencies rose in 2022 and 2023, but they really have eased since then. So I think that the pain was kind of taken in 2022 and 2023. Obviously, if something goes wrong, a recession, anything, these delinquency rates are headed lower. I'll also say that because interest rates are where they are, over 4%, like that's different than 2013. Banks make more money now because the interest rates are higher. So a delinquency, same delinquency now versus 2013, banks, it's better for the bank now because yields are higher. So it's not always a apples to apples comparison. And then Max, so Wells Fargo, similar story. Um, then there's JP Morgan. Okay, so JP Morgan obviously crushed it on the investment bank side. Their loan provisions, credit losses, basically let's call them, were up 9%. If you look at their consumer and community banking, their provisions were down. But actually, if you look at their commercial and investment bank, their losses were up 156%. So the third quarter of 2024, they took a $316 million loss on credit. This year, they took $809 million on credit. Admittedly, quarter over quarter, it's only a little over $100 million increase. But yeah, provisions for JP Morgan were up. So it does show some losses. I think they took, I believe it is $170 million loss on Tricolor. They said they had no first brands exposure, but they had that loss on Tricolor. When it comes to and Jamie Dimon had some interesting comments. I'll just pull up his commentary here, Max. So I'm literally searching the word cockroach to find where I am in the transcript from Fiscal. So there's a question actually from Mike Mayo, great bank analyst, who asked about NBFIs, non-bank financial institutions, basically the same thing as NDFIs, non-depository financial institutions. And he said, what about this risk? Because we know the risk from inflation, the risk of a recession. But Jamie, you always like to think about the risk. What about this risk of non-bank financial institutions? The CFO said, we're not so worried about it. It's structured, it's securitized, a lot of these very high underwriting standards. And then Jamie jumped in and said, that actually, yes, there will be additional risk in that category when we see a downturn. I expect it to be a little bit worse than other people expect it because we don't know all the underwriting standards. And Jeremy, the CFO, said that they are smart players. They know what they're doing. They've been around a long time, but also they're not all very smart. We don't even know the standards that other banks are underwriting to some of these entities, and I would suspect that some of these deals may not be as good as you think. He also said, I probably shouldn't say this, but when you see one cockroach, there are probably more. So Jamie's a little bit concerned. I will say Jamie is kind of always concerned, which is how good bankers and good credit people are. But the risks are there.
So when you're talking about the non-bank financial institutions, that's private credit, right?
Yes, but it is the loans to private credit. So when people talk about private credit, it mostly is Ares, Apollo, all these private credit managers launching a fund and buying loans with money from LPs, investors. But they also use leverage in those funds, and they get that leverage from the banking system. So basically, if there used to be a risky loan, let's say in 2005, that risky loan was owned by a bank. Now that risky loan, a lot of those risky loans have migrated from the banking system to the non-banking NBFI system. So that loan is owned by a private credit shop on behalf of investors, also using leverage from the bank. So the bank no longer is making the loan to the risky borrower. It is making the loan to the entity that owns the risky loan that makes the loan to the risky borrower.
Okay, that makes sense. Well, it's interesting. I was not expecting to have this conversation today, but on OPM, I recorded a conversation with Derek Pilecki. He's the portfolio manager of Gator Capital, which is a phenomenal long short financials focused fund that has compounded at over 22% since their inception in 2008. One of the better performing financials funds. And we talked about private credit risk. That was the final question I asked him today. And he basically said he although he knows that there will definitely be losses at some point in time, he wasn't as worried about it being systemic. So it sounds like Jamie similarly said, yeah, it's there's going to be losses, it's going to be bad, but he didn't quite go so far as to say it's going to be a system crashing thing, which if you are paying close attention to the most bearish people on private credit, they're certainly insinuating that there is this whole house of cards in this thing that's going to take the system down again, a la 2008.
That's an interesting perspective. I won't name him, but another very accomplished financials investor who I know has a similar view that it's not going to be systemic. I will say, and this was on the record, Stephen Kelly, Yale Institute on Financial Stability, he said to me, it probably was 2 years ago, he said, I'm not worried about areas at Apollo, the private credit, because it's not systemic. They don't touch the banking system. That was a well-informed, reasonable comment 2 years ago. But as Stephen, now I imagine he would probably acknowledge the banking system has gotten much more intertwined with the private credit system. So the banking system makes a lot of loans to these NBFIs, so much so that Mike Mayo is asking about it. And when it's on the earnings calls, it's typically has been going on for quite a while. Funny, Max, that so JPMorgan, Jamie said that about the cockroaches in the non-bank financial institution. Blue Owl and the CEO of Blue Owl took that personally. Blue Owl is a leading alternative asset manager, aka private credit, although it does real estate and it also does GP stakes, so like owning stakes in other private equity companies, the actual general partner stake. But yeah, Blue Owl does a lot of private credit, and Mark Lipschutz of Blue Owl, what did he say?
So I actually have the quote for you, Jack, which is it said banks might want to look at their own book for any cockroaches. That's what he said on Tuesday.
But if the loan is bad, it's obvious, it's clear, Max, that if there are these cockroaches, the cockroaches are owned by private credit, but banks have made loans to the funds that own those cockroaches. So both are involved in my book. Again, no view on how many cockroaches there are, but just to kind of explain the plumbing of it. And Mark Lipschutz of Blue Owl also kind of implied that all the banks are jealous. He said that, look, Blackstone's market cap is bigger than the market cap of most financial institutions. There are people who have meaningful parochial interest in the industry, aka private credit, not continuing to grow and succeed. So, yeah,
I mean,
Lipschutz thinks that Jamie's just jealous,
I
which he may be.
I have a couple of the quotes that he gave. So he said, I guess he's saying there might be a lot more cockroaches at JPMorgan. I'm not sure I know what he's saying. It's not a private credit issue. It's a liquid credit market. And then he went on to say these couple of bankruptcies, both of which are in the syndicated market, which would seem to be evidence of the problem away from the private credit market. I understand people have their own business to run, and some people are axed against the product class. So he went so far as to say, look, these blowups have all been syndicated deals, not things that we've been doing.
So, like vanilla direct lending, I think First Brands was not that. It did have a lot of syndicated deals, but I think Jefferies, I don't know, but Jefferies' First Bonita loss was in the factoring thing, which is asset-backed finance. And what are all these alternative asset managers, Ares, Apollo, Blue Owl, what are they getting into, in particular Apollo, like asset-backed finance? So I think, you know, all these private credit people have been talking about how great asset-backed finance is, and maybe that isn't the vanilla definition of private credit, aka direct lending, but it's heavily related. So banks and private credit both do this asset-backed finance thing.
So Jack, I guess my question would be, do you think he doth protest too much?
I don't know. I tons of respect for Jamie Dimon. I do like Mark Lipschutz going on the record and giving it back to Jamie Dimon. Great response. I can't really think of a better one. In the Bloomberg article, it did list that there was, let's be honest, there's always an alternatives conference going on, but that at this particular alternatives conference, Jamie Dimon's cockroach quote did kind of ruin the vibe a little bit. So I think Mark needed to put some of the attention back on Jamie.
So Jack, why don't we turn to some other financials that most people don't really think of as banks, but are, and that's Schwab and Interactive Brokers.
Well, Max, just there is a chart, I think it's from our sponsor Fiscal, but just showing Charles Schwab cash as a percentage of client assets. So you got all these clients, what percentage of their assets are in stocks versus bonds versus commodities versus cash, the safest, least risky thing. And in 2022, during that bear market, it was at 13%. Then it went down to 10% in 2024, went up to 11% during the crash during Liberation Day. It's now back down at 9%. So, unsurprisingly, Schwab clients are risk on. I mean, by definition, people have to be risk on during a bull market. Otherwise, it wouldn't be a bull market, right? And then same with interactive brokers. I believe from memory that their margin accounts, like their margin loans, were up 39% year over year. And just by my math, they were up 9% quarter over quarter. So again, during a bull market, asset values go up. And so if you're levered and asset values go up, your leverage kind of goes down. So you get more levered. That's kind of normal. So just kind of a reminder of what happens during a bull market, and when we eventually have a bear market, and of course we will have a bear market, of course we will have a crash. The question just is when. um it could be in 5 years, it could be in 5 days, but the margin always reverses, and this is something you see across assets under management for ETFs and stuff. Like the the money that goes into an asset is always highest at the top in price, and that kind of makes sense.
That I want to turn to, it's a chart everybody has seen, but generally not in this format. I think we've all seen the fear and greed indicator. And I think they also, if you go to CNN, they have a nice timeline version of it, and it does it by quarter. So you can kind of see that like we actually peaked out on the year for extreme greed in July, right? And then we came down a little bit, and actually yesterday's close, we hit into extreme fear for the first time. But during that period of Q3, we did stay in the greed stage, and we even had some periods of extreme greed. But things have rapidly fallen off in these sort of early weeks of Q4. So as much as we are looking at those cash levels, things have changed in the past few weeks, and it would be interesting. It's going to be very interesting to see how those numbers change when we do eventually get Q4 earnings, and perhaps we'll get some fireworks before then that'll make it all pointless.
Yeah, and no secret that I'm a bull on the semiconductor industry. That had a interesting week in terms of trading, but Max, like the rally has just gotten very narrow, and if JPMorgan and all of these banks that do real things are going down in price, and the only things that are rallying are quantum stocks, I don't think that can last very long. Interestingly, I would have said that last week, and then quantum went up another 30% before going down 15%. So these things are super volatile, and Bitcoin Max is below 110,000. So it appears the market's a little bit risk off.
Yeah, well, let's talk about one asset that is sort of like the king of risk off, and that's gold. It has been absolutely skyrocketing up, with the exception of sort of like the end of the closest week, with the sell off today. Um, but what are you thinking about in terms of gold pricing? Because I know you've been pretty bullish on gold, silver miners, and as well as the royalty streamers.
Yeah, the way I choose to express it has been through the royalty and streaming companies. Max, I thought, when we did record it last week, or was it 2 weeks ago, I thought, oh my God, this rally in gold has been so incredible. It's past 4,000. There's just no way. I'm going to make an easy call and just say, once this government shutdown is over, the price of gold is going to have a little bit of a crash. It's down a little bit today, but the price of gold was well over $4,300. So it went up $300 in a few weeks. This rally is pretty extreme. I literally recorded an interview yesterday with John Turek, and I said the price of gold is up 25% of the way that Pat to 5,000, and then it went up, up to 4,350. So it's a little bit out of control. But yeah, the streamers and the mining companies were down a ton today, even though the price of gold was only down 86 basis points. So yeah, I'm quite bullish on, let's put it, the streamers, Franco Nevada, Wheaton Precious Metals. I bought somewhat of a kind of a degenerate out of the money call option on Wheaton Precious Metals today. And I totally could be wrong here, but here's my prediction. And 95% chance that one of these two things is going to happen. Scenario one, the gold goes down and the precious metals streaming companies, their decline today makes sense. Or scenario two is like gold stays. If gold stays where it is, I'm quite confident that the streaming companies are going to do quite well. And honestly, the miners are interesting. Like I think the streamers are safer, but in such a crazy bull market, the things that don't have a margin of safety. So like a mining company that has a very high all-in sustaining cost is gonna get the most operating leverage. So my way to express it has been, I guess, the least riskiest way, other than gold itself, but that has like kind of made the least money, which makes sense. The biggest risk takers have gotten the biggest reward so far, and that's kind of the way it should be. I'd say that with streaming, I can kind of wrap my head around these deals. Oh, I like this company. Oh, I don't like this company. Um, I tend to not like companies that have been a streaming company but don't actually have a lot to show for it. So like Metalla, I don't know if you know the ticker, but like a lot of their discoveries has yet to be mined. Now I think a lot of it will be mined eventually because it's in such a crazy bull market, but like eventually kind of put up or shut up. I've also been involved with EMX, which is merging with a company called Elemental Altus, but those are kind of my plays. And with the gold stocks, the actual mining, I think that like I wouldn't go so far as to say that if you're not a geologist, you should just give up on trying to pick gold mining stocks, but I'd go pretty close to that. And I've been involved in like trying to buy some African gold company, and I would have done a lot better if I just bought like the gold mining ETF, which is a VanEck, which is a sponsor. But like I just think that diversification is kind of important when you don't have an edge. So I think, I recognize that I don't have an edge in the mining companies. Maybe I'm deluded in thinking that I have an edge in the streaming companies, but to me, it's interesting and fun. Whereas all this gold mining stuff is quite complicated, and especially when you show maps, like heat maps of where the ore is. Like, I don't know. I don't think that that I really have a shot there.
Okay. Well, Jack, why don't we look forward to next week? You talked about recording with John Turek. I alluded to my interview with Gator Capital. I think that's probably going to be the next one that comes out from me. What do you have coming up next week? And is there anything else you're paying attention to? I know bank earnings continue.
So the regional banks are going to report. I'll be tracking for any weakness there, or any strength. And then we're going to get into regular earnings. The Fed meeting is going to be at the very end of this month, I believe on the 29th. Also, Max, I just want to say, yeah, I made a call a few days ago. Last time we recorded, I'm like, oh, this all these Fed cuts, they're priced with such confidence. Like, where is the evidence of these Fed cuts that are going to happen in October and later this year? Yeah, the pricing is kind of confirmed it. So I was wrong there. And I think you've seen a lot of Fed speakers come out and kind of just acknowledge that the cuts are coming. So the cuts are coming. And again, I guess this episode and the previous one, we highlighted the negatives, which I think is appropriate. But it's also just important to remind people that, like, if there's no recession and earnings are growing the way they're growing, and if the labor market bad signs are actually really just because of supply, because of deportations and a slowdown in immigration, then what you have is a scenario where earnings growth is very high and the Federal Reserve is cutting into an expansion. When you have AI, which is an AI capex boom, which shows no sign of slowing, despite the many naysayers. I will also say, Max, I think I'm kind of my natural orientation is contrarian, and I have a bearish bias, so I have to catch myself. So if I see a mainstream narrative and then I have a bearish reaction, I'm like, oh, there's no way that this thing there's no way it's as good as they say. I have to catch myself because often I'm wrong there. But I feel like with this, I've seen a lot of mainstream people. So we're talking about opinion pages and Bloomberg. We're talking about the mainstream podcasts, talking about non-financial commentators, just state that AI is a bubble and that this AI capex is unsustainable. And they may be right in the long term, like 2 to 3 years, which really isn't that long. But I think that in February of next year, like, will those op-eds look good? And like, no, I don't think so. I think that the capex is continuing, and if it's a bubble, I think it's middle innings. And like a lot of bubbles happen because things are so good. And the biggest companies in the world are spending so much money to build out this AI that they think is going to change the world. So Nvidia's revenue is going to be going flat to down this quarter, next quarter after that. I don't think so. So just my take. And yeah, I'm doing an interview with a investment strategist from a large alternative asset manager that a lot of people don't know of. And I think they have their hands in a lot of different pots. And I'd say in terms of the difficulty level of preparation, and just in terms of the facts and figures, it's probably among the most difficult interview to prepare for. So that should be going out next week.
Well, Jack, I know you said some of the Fed FOMC members came out and said the cuts are coming. We did get the president of the Fed Bank of St. Louis came out today and suggested that he could support a path with additional reduction in policy rates if there are further risks to the labor market, but believed that the risk of persistent inflation above target, definitely needs to be contained. And also said that he would need to see. I perceive limited space for easing before monetary policy could become overly accommodative, and we haven't finished the job on inflation. So certainly these cuts that we're pricing in for the end of the year look extremely likely. I'm looking at the pricing right now with the October cut 99% probability on FedWatch. We've got 94% probability on FedWatch for another cut, 0% chance that we pause there. But when we get out to January, we're kind of at a 50-50 from there. So that's where the uncertainty in Fed policy really starts to kick off.
Yeah, so I just looked it up. So Musalem, he is a voting member this year, which means he won't be a voting member next year. So his kind of vote counts for the next two meetings when they're going to cut. Or it's to the market is a virtual certainty they're going to cut, and he doesn't get a vote for when the uncertainty is next year. So I interviewed John Turek. He said he's more inclined to be basically bullish rates, the short end. And I asked him, I said, why not be bullish like the 2 year out? And he said, no, when the labor market weakens, like I think it's weakening, you really want to be bullish kind of the near term contracts. So the spring of 2026, for example. But we'll leave it there. Thank you everyone for watching. A reminder to subscribe to Monetary Matters and Other People's Money on Apple Podcasts, Spotify, leave a review.
Thanks for listening. Looking to check out Fiscal.AI's innovative equity research terminal? Get your 2-week free trial and 15% off your first year at Fiscal.AI/MM. Until next time.
Thank you. Just close the door.